Hello and welcome to the Charter Hall Direct Insights series. I'm Steve Bennett and I'm the CEO of the Direct business here at Charter Hall. I'd first like to begin today by acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past, present and emerging. And thank you all for joining me for this update on Charter Hall and our Direct suite of funds for the September 2023 quarter. Before I begin, I do want to highlight that there will be a Q&A at the end of today's presentation where I'll be answering a number of questions that we've received during the quarter. If you've joined us before, you'll know that there is no live Q&A. However, if you have a question that isn't covered, please do include your preferred means of contact, i.e. phone number or email, and a member of the team will get back to you promptly. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds and the external market, but if you do have questions that relate to your own personal investment situation, we always encourage you to consult your financial advisor, read the product disclosure statement or the information memorandum in full, and pay particular attention to the risks section. Today's presentation will follow a similar format to prior quarterly updates. I'll give a very brief overview on the Charter Hall Group. I'll touch on the direct performance and the unit price over the quarter and longer time periods. I'll talk to some of the key economic and property market trends which we're observing in the market, and then I'll pass through to my colleague Julian Menegazzo, who's the fund manager, who will go through the individual funds in a little bit more detail. So the first slide I'll talk to is the Charter Hall wider group. As you can see, we're invested into all the core real estate markets. At $71.9 billion of real estate, Charter Hall is the largest owner and manager of real estate in the country. We do always focus on strong tenant covenants and long-term leases. At various points in the cycle, this does mean you don't get some of the market uplift when rents are rising strongly, but what we do like is it provides that certainty of rental income over long periods of time. Moving now into the direct business, which myself and Julian are heavily involved in, we manage a bit over $10 billion of real estate. We focus on very high occupancy rates, which is 99.4% on average across the funds, both open and closed funds. We have around 437 tenants. And this is important because it means you don't have single tenant exposure risk and you are diversifying not only across different geographies, but tenant bases as well. And the weighted average lease expiry, as I just mentioned, is quite long at an average term of 7.5 years. Obviously, it does differ by individual fund, where the office markets tend to have slightly shorter lease terms, around 6 years, and industrial funds which have longer term leases because that's what the tenants desire. The slide up there on the screen now shows you the 12-month return, the 3-year return, and the 5-year return across the open suite of funds. Look, it's been a difficult 12-month period, particularly for office markets, which have been recalibrating with higher capitalisation rates and higher discount rates. It's also worth pointing out that the benchmark we use is the MSCI wholesale benchmark. So we're comparing against high quality real estate that superannuation funds and institutional investors go into. It's a diversified benchmark, whereas apart from LWF up on the screen, our funds are sector specific. So whilst the 12-month returns to 30 September have been a difficult period, you can see that for the 5-year period, all the funds have exceeded benchmark. And as anyone that's listened to these videos before will know, I always tell people that property does go through cycles and you should invest for the medium to longer term. So now let's take a look how the funds have performed since they were first launched. The blue column shows individual fund returns over quite long periods of time, and the grey bar shows the MSCI benchmark that relates to that period. Importantly, we have outperformed across all the suite of funds, and this is something that we continue to be focused on, notwithstanding the more challenging and volatile markets that we do find ourselves in currently. And I do know a number of people that are watching this quarterly update are interested in some of the funds which are closed for investment. They are the BW Trust, DIF3 and WPS1. Same format as the prior slide, where the blue bar represents the fund performance since inception and the grey bar the benchmark. And as you can see, each of the 3 funds has also outperformed over the long term. Up there on the screen shows the 30 September ex-distribution unit prices for each of the funds which we manage. Also on the right-hand side, you can see the classification where we've tried to clearly demonstrate that the fund should be considered illiquid and form part of the illiquid part of your investment portfolio. Should you require any more information on unit prices or history, it can easily be downloaded from the Charter Hall website or the additional information which is provided in the hard copy quarterly report which each of you should have received. This now brings me to the part of today's presentation where I'll draw out some of the key trends which we're observing in both the Australian economics as well as specific items that impact the Australian real estate market. You can see up there on the screen we've plotted on the x-axis economic growth and on the vertical axis population growth. The reason why you'll see us often talk about population growth is because in real estate, demographics are your friend. So this trend is something that will play out over the long term, and if this immigration continues up, you will see it flow through to greater demand for all real estate sectors, not just housing, which is often in the press, but industrial and warehousing, office and retail property as well. But what is happening in the real estate market specifically? What are we observing on the transaction volume? And what are we seeing with RBA rates and what does it mean for real estate? The first graph there on the left-hand side shows the transaction volumes across the core real estate sectors where the orange is industrial, blue representing office, red retail, and the small multiple holdings. What you can clearly see is that transaction volume has declined materially. In fact, it's at the same low point as it was when COVID first hit. And why has transaction volume slowed in the real estate market? Well, the key driver is what's been happening with interest rates both in Australia and globally. The chart on the right-hand side clearly shows that we've had 13 interest rate increases since May 2022. In fact, November's most recent increase took the rate to 4.35%. What that's meant is that there's greater uncertainty around property capitalisation rates, discount rates, and return hurdles that investors need to meet. That is one of the key reasons why transaction volumes have slowed materially and slowed across all the real estate sectors at the same time. It doesn't mean transactions aren't happening, but it does mean there is less of them and they are taking much longer to complete. So these trends which I've just talked about, whether it's population growth, slowing transaction volume, or rapidly increasing interest rates, do impact the real estate market. So there are some things which we cannot control, but there are some things which are in the manager's ability to influence and control throughout the investment term. Up there on the screen, you can see a number of the key items which I believe the team have done an excellent job at. The first being our occupancy rate. Across all the asset classes which we're invested into, we materially exceed the PCA, Property Council of Australia, occupancy benchmarks. On the lease terms, we focus on long-term leases, and we have very strong tenant customers, which means we haven't had any material defaults across the portfolio, meaning the income which we're receiving as rentals has been very secure. On the debt management side, we're very lucky in Charter Hall. We've got a very deep and experienced treasury team who are very active on extending out debt terms and financing the best available rates in the market. The only reason why it's orange is because over time your interest rate hedging does roll off, and that as the higher interest rates come through, it does mean that your interest expense does go up as well. On the property improvement side, well, Charter Hall is an institutional manager. It means that we maintain our properties to a high standard. It means we maintain them through active CapEx programs. We focus on high environmental ratings. And this is how you need to manage commercial real estate in this country if you want to attract those tier 1 tenants, which we're always seeking to achieve. And as I just said, the sustainability is something the group have been very focused on for well over a decade. And all our funds have high NABERS energy ratings, and it's an area which we are constantly focused on improving. So whether it's waste, water, or energy, the team are actively moving our ratings up over long periods of time. But it is important to realise that there are things that as a manager just simply can't control. Inflation and interest rates, I've already mentioned that they've increased. That isn't something we have any ability to impact. And what it does mean is it flows on to the next point. It's lifted capitalisation rates and discount rates, not just across property, but across different asset classes as well. This is one of the reasons why a number of the funds have had valuations declining. So capitalisation rates as they increase, or discount rates as they increase, has an inverse relationship to the price of an asset. The macroeconomic environment, look, there are global shocks, there is volatility at the moment, and whilst it doesn't have a direct impact on the Australian real estate that we manage and which myself and Julian are talking about today, it does flow into the inflation, interest rates, as well as reduce some of the offshore demand for asset acquisitions, which has traditionally been very strong. The demographics is one of the positives which I've already talked to, and that's why that's highlighted as green across the long term. And unemployment's an interesting one. We are sitting at around 48-year unemployment lows, 3.6, 3.7%. But there is a feeling out there that it's changing. In fact, the RBA have had a stated objective that they believe it needs to increase to around 4.5% for inflation to come back within their longer term goals. So these are some of the external impacts which we are seeing in real estate. It's part of the reason why real estate does move through cycles as well. But it is important you realise what's happening in Australia and position it from a global context. The first thing to note is this rapidly increasing interest rates isn't a phenomena unique to Australia. You can see up there on the chart across a number of the major economies and markets throughout the world, they've all experienced significantly higher interest rates. So I've already said that higher interest rates have led to some softening in capitalisation rates and discount rates. And importantly, at Charter Hall, we very much believe in transparency. Any asset that wasn't valued at 30 June, we're going through a full independent valuation process like we do through all different markets, and that process will be completed by the end of December. So whether you're in an office fund, an industrial fund, we always believe in having up-to-date valuations, and myself and Julian will talk to those valuations in more detail in the December quarterly report and the video. So before I pass over to Julian, I might draw together some of those concepts which I just talked about. The first thing to note is Charter Hall is a very experienced manager. We've been looking after real estate in this country for well over 30 years. We have 600 property professionals located in all the markets where we own assets. And that's important in real estate. If you want to drive strong outcomes and returns over the long period of time, you do need people located on the ground where your assets are. There are challenges that we're observing in the market. These challenges are not unique to Charter Hall, and they're not unique to property. So we will go through our regular valuation processes as per normal, but as I said, the higher interest rates are leading to higher discount rates and capitalisation rates and creating some more volatility and variability in valuations. So a number of these external factors, which I've already talked about, higher interest rates and inflation, are putting pressures on real estate pricing just like they are in other sectors. I'd now like to invite Julian Menegazzo, the fund manager, to provide an update on the performance and capital management across our direct suite of funds.
Thank you, Stephen. Starting with the industrial and logistics sector, and there are some market fundamentals that continue to benefit the sector that are continuing to play out. A lack of available space continues to limit tenant movements nationally, and you can see on this slide the high occupancy rate that continues to benefit the sector. Leasing demand and limited land supply is driving low vacancy rate across all major markets, now sitting at under 1% and 0.6% nationally. You can see on screen how the vacancy rate across all national markets has compressed from the second half in 2019 when it was sitting at over 6% on a national level. The imbalance between the tenant demand and available space continues to generate significant rental growth. Over the 12 months to September, the national rental growth rate is now sitting at 16.5% on an annual basis. Rental growth is expected to remain above long-term averages over the coming periods, underpinned by high tenant pre-commitment levels, a rise in construction costs, and limited land supply above long-term averages. Despite the positive fundamentals in the industrial sector, we have seen transaction volume significantly decrease in the 12 months to September, well below the 10-year average, as you can see on this slide. By number, there were only 192 transactions in the 12 months to September, or $6.7 billion by value. This is well below the historical volumes when you compare to the 10-year rolling average. We are seeing transaction volumes slow across all sectors, and one of the main drivers, as Stephen mentioned earlier, has been the rapid increase to the cash rate by the RBA, with 13 increases since May 2022. This has significantly increased the overall cost of debt for investors, putting pressure on target return yields and overall values across the sector. I will now move into the update across the direct suite of funds. The first fund I will cover today is the Charter Hall Direct Industrial Fund number 4. DIF4 has a portfolio value of $3.4 billion across 59 directly held assets. It has 100% occupancy and provides a 10-year weighted average lease expiry profile. You can see on screen both quality and diversification of the top 10 tenant customers on the right-hand side, comprising of 57% of the fund's overall income. DIF4 has delivered a 10.2% investment return since the fund's inception, having benefited from the industrial market fundamentals that are continuing to play out across the sector. The fund also pays distributions on a quarterly basis. On this slide here, you can see how the fund's been actively curating its portfolio, divesting over $135 million of assets identified as non-core over the previous 12 months. The proceeds from these sales will be recycled into quality assets that will complement the overall DIF4 portfolio. The next slide is the Charter Hall Long WALE Fund, or better known as LWF. This is our diversified fund that is open for investment. LWF provides investors access to a diversified portfolio of $375 million over a number of sectors, including industrial and logistics, social infrastructure, office and long WALE convenience retail. The fund's top 5 tenants comprises over 60% of the fund's overall income, benefiting from the federal and state government, Coles and Bunnings tenant covenants. The fund also benefits from a 7.1-year weighted average lease expiry profile and a 99% occupancy rate, and targets properties with long leases and structured rental increases. LWF pays distributions on a monthly basis. Following the recent 5-year liquidity event of LWF offered to all investors earlier this year, those investors that chose to redeem out of the fund would have received their liquidity in full earlier this month. The next 5-year liquidity event for LWF will be held in 2028. I will now move across to the office sector. Despite the recent media headlines and what some are calling a structural shift in the sector, tenant demand does remain positive. This slide up on screen indicates the vacancy rate across all major office markets, with the national vacancy rate across the office sector now sitting at 15%. However, if you do have a close look at the vacancy rate across each market, you can see a clear trend, with vacancy diverging by asset quality and asset age. Vacancy for assets above the age of 10 years, which are indicated by the grey bars on screen, have a vacancy rate of around 13.8% nationally. By contrast, offices built or that have undergone a major refurbishment over the past 10 years have a vacancy rate of 7.2%, indicated by the blue bar. This spread between vacancy rates further highlights the bifurcation between prime grade assets and secondary grade assets across the office market, and the flight to quality that both tenant customers and investors are now seeking. The occupancy rate across the office funds in DOF and PFA sits at 99% when compared to the national average of 85%. This has been driven by a number of factors, including higher construction costs, higher economic rents and softening yields. Whilst you might not see the impact of this over the short term, this may put pressure on the overall supply over the longer term. Despite this, the office sector, similar to industrial, is facing challenges outside of our control, like softening yields, lower transaction volumes, and the impact of the RBA cash rate continuing to increase. Whilst we can't control the slowdown in transaction volumes and market movements, we can control leasing outcomes and keeping our buildings full and ensuring they are generating as much income as possible. The asset management team at Charter Hall continue to focus on maintaining higher occupancy and driving positive leasing outcomes across DOF and PFA. Both funds collectively completed over 16,000 square metres of leasing in the September quarter. And you can see on the right-hand side up on screen the occupancy rates across DOF and PFA sitting at 99% respectively, and how they compare to the overall average, PCA average of 85%, which is a great result in the current environment we find ourselves in. At Charter Hall, we have property professionals located in all major office markets. This provides us a deeper understanding on what our tenant customers are seeking and assists us in keeping our buildings fully occupied and generating income. Moving to the Direct Office Fund, or better known as DOF, which is open for investment. DOF is a $2.8 billion office fund, and its investment strategy focuses on core CBD and established Australian office markets, with 94% of the portfolio weighted to the Eastern Seaboard office markets. The top 5 tenants in the fund comprise of close to 55% of the fund's income and benefits from over 30% from federal and state government tenants, as well as exposure to high-quality tenant customers including Western Sydney University, Coles and Westpac. The fund benefits from a high occupancy rate of 99% and a weighted average lease expiry profile of 6.2 years. DOF has provided investors an 11.5% total return since inception and benefits from a 5-star environmental rating. The fund pays distributions on a quarterly basis. Over the quarter, DOF was successful in divesting an asset located in Melbourne at 1 Nicholson Street. This followed an on-market sales campaign earlier this year. Identified as a non-core asset within the fund, this transaction enables us to continue curating our portfolio in line with the fund's investment strategy. Our other sector-specific office fund is the Direct PFA Fund. The fund benefits from a very high occupancy rate of 99% and has a portfolio of over $2.2 billion in office assets spread across the Australian office sector, with 74% exposure to the Eastern Seaboard market, and provides investors a weighted average lease expiry profile of 5.7 years. The PFA Fund has a focus on properties leased to state and federal government. The government rental streams account for over 60% of the fund's net income. The fund has provided investors with a 7.2% total return since inception and also benefits from a 5-star environmental rating. Management are continuing to work through PFA's liquidity, noting the challenging lower transaction volumes occurring across the sector. We will endeavour to provide investors an update as soon as we are able to. The next fund I will cover is the Wholesale Property Series No. 2, or better known as WPS2. This is offered to wholesale investors as defined under the Corporations Act. WPS2 provides a long weighted average lease expiry profile of 11.7 years and a high level occupancy rate of 99%, providing investors exposure to a diversified property sector allocation. The fund provides investors exposure to a diversified sector of allocation across core real estate classes including industrial and logistics, social infrastructure, office, long WALE retail, and a small allocation to the listed AREITs. This provides access to some of the highest quality assets across the market through Charter Hall's wholesale funds and partnerships. The next fund is our Maxim Property Securities Fund. This fund is a little different to all the other funds discussed today, as it invests in stocks traded on the ASX. In line with recent Australian equity markets performance, the 12-month return to September 23 of the fund delivered a total return of 5.7%. Over the 10 years, the fund has delivered solid performance, returning 8.4% above the benchmark of 7.6%. The fund maintains a high conviction active management approach that favours fundamental property investment themes, particularly in alternate property sectors, rather than following the broad index. As I mentioned earlier, this product is a little bit different as it invests in listed stocks, and we encourage you to read the information memorandum or consult your financial planner to understand the risks around this type of investment. Finishing up the fund update today, I will now cover the fixed life funds. These funds are closed for new investment and are covered across BW Trust, DIF3 and WPS1. The BW Trust provides investors with access to a Bunnings portfolio with an average lease expiry profile of 5.2 years and is valued at $138 million. The review event for the BW Trust will occur in Q1 2024 and management will write to investors over the coming quarter. DIF3's liquidity event is not until Q3 2024. The fund provides investors with access to a portfolio that is 100% occupied and benefits from a lease expiry profile of 10.2 years. The final fund is WPS1, and this provides a weighted average lease term of 9.1 years and is currently in the fund's 3-year investment period. This now brings me to the end of the fund updates. I will now hand back over to Stephen to cover off a number of questions that have been submitted over the quarter. Thank you.
Thank you, Julian, for that update on the specific funds. This now brings us towards the end of today's presentation, but I do have time for probably 1 or 2 questions which have been sent through. So the first question that's been sent through is, what does it mean for the outlook on commercial property? Unfortunately, there's no simple answer. I wish there was. There are some positive trends around particularly long-term fundamentals, such as you heard in office supply from Julian coming off, population growth being very strong. But it is undeniable that with higher interest rates throughout Australia and the globe, market participants are reassessing the right level of capitalisation rates and discount rates. This isn't a trend that's unique to Australian property, Charter Hall. It's happening globally, and it's happening across different asset classes as well. So whether it's equities or whether it's the fixed income, capital market side of things, higher interest rates are still working their way through the system. I've probably only got time for this one last question. It's something that has been asked numerous times throughout the quarter. The question is, if DOF and PFA have such strong tenant fundamentals, so very high occupancy rates, high quality tenants, why has the short-term performance over the last 12 months been negatively impacted? Well, it's almost a follow-on from the prior question. Valuations have come off across the office sector as capitalisation rates have increased. So what I can say is that by keeping these occupancy rates higher, it has reduced the impact that would have happened if we had bigger income holes or lower quality tenants. So whilst performance for those two office funds has been negative over the last 12 months, because of the quality, it's been less negative than we believe it otherwise would have been. That concludes our update for the September 2023 quarter. Thank you for joining me today, and I hope you've gained some insights into our funds, the economic and the property market, as well as what's happening globally. For those of you after more information on the industrial logistics market, I'd encourage you to watch an in-depth conversation with Richard Stacker, who's the Industrial and Logistics CEO at Charter Hall. This will be available on our website at the conclusion of this webinar. If you have any questions or something you've heard today or require additional information, please do get in contact with our team who'll be more than happy to assist. Thank you very much.